Hello everyone and welcome to this week's update. I hope you're all doing well. As always, just a quick reminder, if you like these type of videos, please do subscribe to the YouTube channel. It just ensures that you get notifications for when these videos are released so you don't miss one. And also we've recently just launched a new video on the YouTube channel all about cashing in your pension, what the rules are, what you can do, what you can't do. Hopefully you find that really useful, so do check that out. And if you like it, give it a thumbs up. Tick on the YouTube channel, and like I say, do please subscribe and leave any comments you've got on the videos. So kicking off with the stock markets over the last week, they've been pretty flat because they're in a bit of a wait and see pattern at the moment, waiting to see what's happening with the latest coronavirus case numbers. Our countries continuing to get on top of their numbers, what's happening, what will the result be of the latest sort of lockdowns, particularly in Europe. So a bit of a wait and see there, but also waiting to see what's going to happen with central banks. What sort of measures are going to be announced next to help boost the economic recovery? What's going to happen to interest rates? So a bit of a wait and see for stock markets. They're not doing too much at the moment. Sticking with the coronavirus, we unfortunately have seen case numbers start to rise in the Asia Pacific region. So the likes of South Korea and Japan have started to see a steady rise of case numbers again. And if you remember, these were countries that had got fairly on top of the virus of late, but it just goes to show that this virus just doesn't go away. You can lock down your country, but as soon as you open things up again, the case numbers start to go back up. So really the only way out of this is going to be a good vaccine. And luckily we had some more positive news on another potential vaccine this week from drugs company Moderna. So a bit like the Pfizer vaccine we saw last week, when Moderna released the results of their latest trial, they've actually found that theirs could be potentially slightly more successful than the Pfizer one, at about a 95% success rate. Also particularly good in the over 65 categories. So lots of positive news there. And the big thing with this Moderna vaccine is the fact it can be stored and transported in sort of regular doctor type freezers or fridges, rather than the big sort of dry ice conditions that the Pfizer vaccine needed to be stored in. So some good news there. And sticking with the Asia Pacific region, there was some big news for this region this week, which kind of went a bit under the radar, but a new trade agreement was signed by 15 countries in this region. This included the likes of China, Japan, South Korea, Australia, New Zealand. And what it's called, I'll have to check my notes because I want to say this right. It's called the Regional Comprehensive Economic Partnership even. So the Regional Comprehensive Economic Partnership, jazzy name, really rolls off the tongue. And this is quite significant because it's basically trying to turn that region into a bit of a trading bloc, a bit like the EU or North America. And it basically is going to allow a lot more free trade between those countries. And we're talking, with the 15 countries that have signed up, we're talking about a third of the global population now involved in this trade agreement, and about a third of the global economic output coming from this trade agreement. So it's very significant and is likely to boost that area of the world significantly in terms of economic power. And another reason why this is important, and it's also a good reminder, when you're looking to build your investment portfolio and diversify, you want to be globally diversified. You want to look at areas of the world that have the most economic impact. So there's a phrase in financial investment world called home bias. So typically when you're building your investment portfolio, if you're in the UK, you will tend to stick with investing more into UK-based investments and UK-based companies because it's what you know. You'll read about them in the news a lot more, and you just feel comfortable knowing the country that you're in. But when you look at the global economy, you can see just how small the UK is in comparison to the likes of China, Japan, the US. And companies that are involved in these areas, the likes of Japan and China and the US, are going to have far more potential for growth in those areas than they are focusing on just the UK market. So do look at the global economic area when building your investment portfolio, and do diversify into the regions where economic growth is going stronger. And just finally this week, just to touch on, I'm going to talk about a subject called inheritance tax and inheritance tax planning. Now, we've done an article, a more detailed article on this subject on the website this week. So if you go to the website rtsfinancialplanning.co.uk under news and views, it's the latest article. And it's all about when is the right time to plan for inheritance tax. So this is a question I get asked quite often from clients. They'll sort of say, when should we be looking to plan for inheritance tax? Just as a reminder, inheritance tax is a tax of up to 40% that's paid on your assets once you die. Okay, you have to be worth a certain level. Once you're at that level, you could potentially pay 40% tax on everything you own. So when's the right time to sort of plan to try and avoid this tax? Well, there's no such right age to be planning for it, because inheritance tax is not due at a certain age. If you're a 19-year-old and you're worth £1 million, it's likely that if you died, you would pay inheritance tax. But if you're a 19-year-old, your priority is probably not going to be looking at planning for inheritance tax. Your priority is probably going to be saving for your first home, paying off debt, looking at getting insurance. So the time to when to plan for inheritance tax is when you balance your other financial priorities. So for example, as you get older, a big financial priority is going to be retirement planning. So there's no point planning for inheritance tax if it jeopardizes the point at which you can retire and the level of income you're going to have in retirement. So so the time to plan for inheritance tax is when you've been able to balance your other financial priorities. Some of the ways that you're going to look to plan around inheritance tax is going to be, one, spending. You can spend away your wealth. The taxman can't come after wealth that's not there anymore. Gifting. So this could be gifting to your family, to your children, or it could be gifting to charities. By gifting, you're releasing money out of your estate into others. So again, it's not going to be there for the taxman to get once you die. Other ways to save inheritance tax are going to include insurance. So you could set up an insurance policy, pay regular premiums, and on your death there'll be a lump sum to help pay the inheritance tax bill, which protects your other assets. And also there's investment products out there that are what we call inheritance tax friendly. So by investing into these types of products, it means that your money is outside of your estate from an inheritance tax point of view. But all these kind of plans are going to involve you giving up control and access to some of your wealth to help plan for inheritance tax. So this is why we say, making sure your other financial priorities are sorted first before you can look at targeting inheritance tax planning. But like I say, there's a more detailed article on the website this week, so do check that out. Okay, so that wraps up this week's update. I hope you found it useful. Until next time, take care.